These are two videos saying completely different things about Bitcoin that was posted during the same time. If you are watching this video, the chances are you probably heard someone give their opinion on where the price of an asset is going. But if you ask them how exactly price gets from one point to another, they would know. But by the end of this video, the way that price moves will be self-evident to you. Because when you break it down, it's actually pretty simple. So let's get into it. Let's imagine that Tesla is trading at $10. How does it get to 11? In other words, what needs to happen in order for the price to get to 11? That is a question that will be answered by the end. But before we dive deeper, let's set up three basic principles in trading. First, there's only one way for anyone to make money in this business. Only one way. It doesn't matter what tools you are using or what strategy you are employing. To make money, you have to buy something at a lower price and sell it at a higher price. You can also sell high and buy low, which is called shorting. The second principle is that there's only three things that anyone can do in the market. You can buy, you can sell, or you can wait. And the third is that everyone in the market plays with the same goal. Everyone is trying to turn their money into more money. As in, there's no one that puts on a trade with the sole purpose of losing money. Because to be honest, there's way more fun ways to lose money than looking at charts all day. These principles are important to keep in mind because this is the base upon which I will build your understanding about how price actually moves in any market. Now let's get back to our example. If the price is at 10, that means we have bids at 9 and offers at 11. Bids are the highest price that a buyer is willing to buy at, and an offer is the lowest amount a seller is willing to sell at. Bids and offers are like two sides of the same coin where a bid is connected to an offer. More on this later. Just like in any market, whether it be a Walmart or the stock market, there are only buyers and sellers. Bids are the price buyers want to buy at, and the offers are the price sellers want to sell at. And in every price level, there are bids and offers. On the first principle, I said that there's only one way to make money, which is to buy low and sell high. In relation to this example of price being at 10, we can confirm that 9 is low and 11 is high. So in order for price to get to 11, someone has to think that 11 is a good price to buy. For this to happen, all the offers at 10 has to be filled by the bids. In case you didn't notice, there's a contradiction between what I just said and the previous principles I laid out. I said that there's only one way to make money, which is to buy low and sell high. If the last posted price is at 10, that means 10 is the high relative to the previous prices. If the only way to make money is to buy low and sell high, why would anyone buy at a higher price? Why wouldn't you just wait to buy at say 9 or lower? It's because of conviction. It's because the buyers say that my conviction or belief that price will go up is so high, I'm willing to do the opposite of what it takes to make money, which is to buy high. And inversely, why would anyone sell at 10? Because you have the conviction that price is high and expect it to come down. You may have different reasons for entering a trade. It could be because some kid on TikTok said so, which I really hope you don't take seriously. Or it could be your indicator showing a signal. But when you break it down to the basics, the reason you are buying is because you believe price is going up, and the reason you are selling is because you expect price to come down. When price is at 10, there are people looking to buy and looking to sell. This is where futures contracts comes into play. What a futures contract does is it connects two traders with diametrically opposed ideas. So when you think price is going up and you buy, you are entering an agreement with another trader who thinks price is going down. Based on the next move the market makes, one will be a winner and the other will be a loser. And the money that is made by the winner is coming directly from the account of the loser. This idea of buyers and sellers having different convictions isn't just limited to futures contracts. This is how all trading works, whether it's stocks, options, or any other financial market. Every time you enter a trade, you are taking an opposing view to someone else in the market. Trading is essentially a constant push and pull between those who believe price will rise and those who believe they will fall. Futures contracts simply formalize this relationship with specific terms and expiration dates. But the fundamental dynamics remains the same across all markets. Let's take the example of price being at 10. If at 10 there are 100 bids but only 70 offers, once all the sell orders are filled by the buyers, there are still 30 bids left. Since there are no more sellers at 10, those remaining bids needs to find sellers at the next available price level. So price moves to 11. At 11, if there are 70 bids and 60 offers, plus the 30 bids carried over from 10, all the sell orders are again filled and the excess bids push the price up to 12. However, if at 12 there are 100 offers but only 30 bids, the imbalance shifts. Since there is an excess of offers, price will move down to the next point where there are more bids, which is 11. This is how price moves. All price movement comes down to the imbalance of conviction between the buyers and the sellers. When buyers outnumber sellers, the price rises. When the sellers outnumber buyers, the price falls. At every price level, traders have opposing views. Some believe the price will go up, while others expect it to come down. If there are more bids than offers, that means more traders are buying, and buyers only buy when they expect price to rise. This imbalance drives the price up. Conversely, if there are more offers than bids, it indicates more traders are selling, expecting the price to fall, and this causes the price to come down. All price movement is a result of the imbalance of conviction between the buyers and the sellers. All other reasons that people buy or sell, whether it's because of something they saw on the news, a tip from a friend, or a signal from an indicator, are built on top of this basic principle. Even though traders may have different motivations for entering a trade, it always comes back to this simple dynamic. If there are more buyers than sellers, price goes up. If there are more sellers than buyers, price comes down. It's simple as that. Now let's apply this understanding to our trading scenario. Suppose you bought at 10 with the expectation of selling at 13 to make a profit. We now know that for the price to reach 13, the offers at 11 and 12 must be absorbed by the bids. This means other market participants have to buy at a worse price than you did for the price to climb. In other words, you are completely dependent on others in the market to make you a winner. If there aren't enough buyers to take out the offers at 11 and 12, the price would objectively start coming down, resulting in you losing money. Understanding this can greatly help you with your trading mindset. It shows that the reason you made money was not because of the signal from your indicator, rather simply because more people decided to buy instead of selling. By truly realizing this, it helps you shift your focus on the process rather than focusing on the outcome. The process is following and trusting your trading edge to give you a favorable outcome over a sample of trades. When you focus on the process, the profits will take care of itself. So to summarize, markets are made up of buyers and sellers. It doesn't matter if the market is for Bitcoin, Tesla, or the Nasdaq. Everyone's goal is to make money. The only way to make money is to buy low and sell high. These buyers and sellers are connected through contracts, and in each contract there are two traders with diametrically opposed beliefs. One expects price to go up, the other expects it to come down. At every price point, there are buyers and sellers. When there are more buyers than sellers, price goes up. If there are more sellers, then price comes down. It's simple as that. All price action is the result of an imbalance of conviction between the buyers and sellers in the market. This is why technical analysis works, because the market has a memory. By identifying patterns and trends, over time you can gain an edge and predict where the price is more likely to move, while also thinking in probabilities. And on my next video, I will explain how you can develop a trading edge that fits your style. If you enjoyed this video and got some value out of it, please consider liking and subscribing. And if you have any questions, feel free to comment below. I post all of my trades on Discord for free because unlike the majority of trading channels, I actually trade. And you can follow the link in the pinned comment and see how I trade for free. Thanks for watching, traders, and I'll see you in the next one.